Recording in progress.
Good afternoon, everyone. I want to welcome you all to the Tax Resolution Help Center. My name is May. I will be hosting today's session and introducing today's speaker. I will also be coordinating the Q&A chat session at the end of the session. I want to congratulate all of you for taking steps to deal with your taxes. Taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax, represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of the wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how much you pay in tax by educating and informing you on ways to reduce past, present, and future tax expenses. We think you are entitled to live a happier, healthier life by keeping more of what you earn and getting the taxman off your back. Our goal is to provide you good information with the opportunity to ask questions that are important to you. The presentation will last 20 minutes plus 20 to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. And to better understand what might be on your mind during the session, I might include some polling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, the session will be recorded. The topic for today's session is filing your tax return, dealing with rental properties, and Schedule E. And the tax expert for today's session is John Shantz. John is, as both a business advisor and a business owner, John has a distinctive perspective. With his broad range of experience, business owners and staff can better navigate this subject that no one likes to talk about tax compliance or the consequences of non compliance. With that said, introducing John Shantz.
Thank you, May. Sorry about that. Just had a few little trouble with clicking the right button there. And thanks to everybody for being here and attending today's session. So today we're going to talk about dealing with rental properties and Schedule E. Rental real estate's one of everybody's favorites when it comes to trying to pick up some passive income and pick up another revenue stream. Quick little bit about me. Here's my contact information, email and phone number. You are welcome to contact me after this session. If you ask a question and don't get an answer that's quite complete for you, feel free to call me. I will do my best to help you out to the best of my ability. Quick little background about me. I was in public accounting for about 10 years, and then I spent about 28 years in real estate development as a home builder and land developer, and successfully retired from that. And now I'm back doing some accounting and tax work. So love to share my knowledge with you and help you out with any questions you have. When I'm not working, I'd rather be skiing. That's my favorite thing to do. I hope you have something you love to do, and everybody works hard. Hopefully you can use what you work for to do something you love. let's talk about a few objectives here of today's session. We'll talk about rental real estate. What is Schedule E? We'll talk about basis and depreciation. Using some fancy accounting words here, if you haven't ever heard of them, we're going to talk about capital improvements and repairs and maintenance. And then we'll touch on the passive loss rules, which impact real estate investors. So rental real estate, why own real estate? One of the great things about real estate is you can use leverage, which can be great until it's not. It's easy to get over leveraged in real estate as well. But one of the nice things about leverage is you can go out there and, buy a $250,000 asset with maybe 10% down. So maybe it only takes $25,000 cash up front to get the asset. Obviously, it takes some cash to keep owning that asset. But it allows you to control a relatively large asset for minimal cash up front. Cash flow versus taxable income. Another nice thing about real estate, throws off deductible losses in the form of usually depreciation. But depreciation doesn't cost you cash. There's no cash going out the door for depreciation. So you get a tax deduction for the depreciation. It keeps your taxable income low, or maybe even creates a taxable loss, but you're still cash flowing on the property. You're still actually putting cash in your pocket. Different types of rentals, house hacking. Talked to a lot of people who like to buy a house and rent out a few rooms in their house, or maybe even a duplex, live in one half and rent out the other half, which can help pay for the half you live in. Vacation home rentals in the form of like Airbnbs or VRBOs. And then you also have commercial rental property. Those are the main things we see. A lot of people into the Airbnbs and VRBOs these days become very popular over, the last, 10, 15 years or so. So Schedule E, what is Schedule E is used to report the income and loss from rental real estate. It's also used for partnerships, S corps, and a few other things that we're not going to talk about, but I just wanted to mention there's other information that can go on this form as well. We'll take a look at an actual Schedule E. This is what's buried in if you have a rental property, you may have seen this. If you look at the detail of your tax return, Schedule E is used to report the income and expenses from your rental property. So we're going right over here and entering our rental income and then all our associated rental expenses. And this form here can used to report 3 properties at a time. If you have more than 3 properties, you're just going to fill out more Schedule E's. Some important information on here that gets reported that the IRS wants to know about is whether you're required to file any 1099s. So if you have any contractors, unincorporated contractors doing work on the house, you may be responsible for filing 1099s. If they did enough work for you, usually over $600. Report the type of property, whether it's single family, multifamily, vacation, commercial, land, and some other items there. You're going to report the fair rental days, how many days it was rented at fair market value. You're supposed to rent your property at fair market value. If not, you're going to run into some limitations on deductions. And then personal use days. If you're splitting the property between personal use and rental use, like a vacation home, you're going to need to report that. And then qualified joint venture. A lot of times you see that with husbands and wives who own a house together. I won't get into qualified joint ventures in any detail today, but I just want you to be aware of it. And then page 2 over here is for other information, partnerships, farm property. We're not going to get into that in reporting passive income and losses. So that's what Schedule E looks like. Let's talk a little bit about basis. Basis is kind of it's not a fancy word, but it's a word for, hey, what's the cost of that property? What did it cost you? Both in the initial purchase price, maybe some cost to settle that purchase. You might have had some legal fees, maybe there's some engineering fees, survey fees. Those are going to go into the cost basis of the house, or the property, I should say. We need to know the basis because we use the basis to compute depreciation. And as I mentioned before, depreciation is one of the great expenses you get out of owning rental property. So you're going to need to know a couple of things here to get the cost basis, which is what you paid for the house, adjusted basis, which is the cost basis, plus any improvements you might have done to the property, less the accumulated depreciation. We'll talk about depreciation a little bit more in a minute here. You need to know adjusted basis for when you go to sell the property. That's why you need to keep track of the adjusted basis, and record keeping is very important when it comes to rental real estate, because if you're holding on to it for many years, you're going to need to determine these cost basis and adjusted basis numbers. I won't get into this too much, but there are times when maybe the cost isn't used to determine your basis in the asset. If you inherited property or if it was gifted to you, there's some different rules used to determine what your basis is for purposes of depreciation. And then lastly, land versus building. You need to break out the land costs from the building because you can't depreciate land. So depreciation. As I mentioned, you need the basis in order to compute depreciation. Land cannot be depreciated. One of the biggest things I see when looking at people with Schedule E's and rental property is they forget to take the depreciation, or they don't break out the cost of the land. If you don't depreciate the property, and then sometime down the road, you go to sell it. If the IRS ever looks at this, they're going to basically impute the fact that you took depreciation, which is kind of the worst of both worlds. You didn't get the deduction while you owned the property. And when you go to sell the property, you're going to end up recognizing a larger gain. So if you have a rental property and you're not taking a depreciation, you're going to want to fix that. There are ways to fix it. You can file an amended return. If you've only owned the property for a couple of years, it's an easy fix. If you've owned it for longer than that, you might want to file, or you're going to want to file for a change in accounting method, which is done on Form 3115. And you might need professional help to get that thing taken care of. Residential property is usually depreciated over 27 and a half years. Commercial property is over 39 years, so a little bit longer. But again, depreciation is one of the great things about a rental property because it's a tax deduction without having money coming out of your pocket. So another big area here and you can use this to your advantage in helping generate some expenses and reducing your taxable income, is capital improvements versus repairs and maintenance. Maybe not ideally, but to the extent you can put your expenses into the repairs and maintenance bucket, you're going to get a current deduction. You're going to get a deduction in the current year against your rental income. If it's a capital improvement, it's something a little bit redundant here. You're going to have to capitalize and depreciate over a number of years, depending on what type of expense it was. To give you an idea, capital improvements are something that's more longer lasting. So if you do a whole roof tear off and put a new roof on, that's typically a capital improvement. If you have to fix the roof, maybe a small area is leaking, you got to fix a vent up there, that's a repair and maintenance. Painting's another big one people ask about. Painting can generally be considered repairs and maintenance. If you're rehabbing a house and you're painting the house, as part of that rehab, that's going to go into a capital improvement in that case. But the main thing here is, if it's a normal repair and maintenance of the house, just keeping the house in good working order, it's a repair and maintenance. If it's longer lasting, you're going to want to capitalize it. Income and expenses. So, all rents are income. Advance rent is recorded in the year received. Something like security deposits, if there is the potential, you're going to have to give this money back. That's something you don't have to record as income until the year that you decide to keep it. Somebody leaves and you keep their security deposit, then it's income at that point in time. All ordinary necessary business expenses are deductible. So, you're going to want to keep good records. You want to keep track of what you spend on your rental property so you can get the full deduction you're entitled to. One thing I like to advise people on is keeping a separate bank account for the rental property. Kind of makes it easy at the end of the year to keep track of stuff. Hey, if you didn't write everything down, you're not 100% sure of everything, at least you can go to that bank account. If all your expenses and all your income went to that one bank account and you didn't put personal stuff in there, it's going to be much easier for you to kind of recreate your records, for lack of a better term, and be accurate so you can get the full deductions that you're entitled to. And make sure you're recording all your income. If somebody ever looked at your books, you want to make sure you record all your income. And also keep in mind, you can allocate costs. If you get a duplex or house hacking, vacation property that may be used personally, you're going to want to keep good records of how you're allocating the costs between the rental portion and your personal use of the property. Passive loss rules. This is where real estate starts getting a little more complicated. Rental real estate is generally considered a passive activity. What does that mean? It means some losses may not be deductible. If your adjusted gross income is in excess of $100,000, you may not be able to deduct all your losses on the property if the property is generating losses. If your modified adjusted gross income is under $100,000, you can deduct up to $25,000 in passive losses against your ordinary income. Ordinary income is typically your wages, W-2 wages, or if you had a Schedule C, you had your own small business, you could deduct it against that income. So that's one of the nice things about real estate. A lot of times it does generate a loss that you can deduct against your other income. And again, you can deduct up to $25,000 if your income's low enough. Now, if you can't deduct the passive losses in the current year, you get to carry them forward. Maybe you get to use them in a future year. And if nothing else, you'll be able to use those losses to offset any gains when you go to sell the property, or at that point you just generate a loss and you can deduct those losses in the year of the sale. So they're not lost forever, just basically a timing difference or deferral of the loss if you can't take it in the current year. Some other issues that come up in real estate: active versus material participation. If you materially participate, you're a real estate professional, some different rules and loss rules may apply to you. So we'll keep that in mind. When you go to sell the property, the depreciation recapture, a portion of that is going to be taxed slightly differently. So most capital gains are either 15 or 20% tax rate. When it comes to recaptured depreciation, it can be taxed up to 25%. So can still be lower than your regular income, but it might be taxed at just a little bit higher rate for a portion of the gain. So keep that in mind. Can be a little complicated when you go to sell your property. Tax software will take care of that for you, but you're going to want to be aware of it. You might run into issues if the property is owned by an LLC. A lot of people don't like to do that. own real estate in an LLC, there may be some legal reasons to do it. There may be some tax reasons not to do it. At-risk rules, you're not going to get a deduction for like mortgage interest if you aren't the owner of the mortgage. Somebody else is covering that mortgage, or you're not going to be responsible for it. You may have some limitations. Home office, business use of auto, if you own several or multiple rental properties, you may have the opportunity to deduct some of your automobile expenses, or maybe you have a home office used for your rental real estate. You might be able to get a deduction for that. So that can help reduce your income taxes. Personal use rules, anything under 14 days of rental income, you can kind of be a freebie. You can record that income. It won't be taxable income. So keep that in mind. If you're just renting out something just for a very short term one time, you might have a big tax benefit there. Net investment income tax gets into if your income's high enough and then you have rental property that's generating income, you could get hit with some additional tax liabilities there. So again, it gets a little complicated here, but I just want to brush across those things. It's kind of like, keep in mind, you got to think about some of these things when you're doing your return. I'm not pushing for myself or anybody to do your return, but if you have enough complications there, it might be worth having a professional take a look at things. So a quick summary here. Income and expenses for rental property, go on Schedule E. Make sure you're tracking your cost basis, breaking out the land versus building, taking your depreciation on an annual basis, and keeping good records so you can break out capital improvements versus repairs and maintenance. Get the full benefit that you're entitled to. And then a couple other issues here. I'm not going to touch on those right now. And that's a quick summary. Hope that helps you out and gives you some things to think about. I want to thank you very much for attending today, and we will just throw this out to the chat if anybody has any questions. Again, there's my contact information. Again, you are welcome to call me and pick my brain if you need to. Thank you.
All right. Well, thank you so much, John. Yes, we do have a question here. This is from one of our attendees in Zoom, from Dave. His question is, when completing my rental information or info, the tax software asked me if I am in the real estate business. Why is this a question asked?
Yeah, if you're in the real estate business, if you're considered a real estate professional, you would not be subject to the passive loss rules. So if rental real estate is your business, there may be an opportunity there where you can avoid some of the passive loss rules. But that's why they're asking.
Nice. All right. Well, thank you so much for that answer. And we do have another question here. This is from our viewers in Facebook, from our live. Hold on. Let me pull that up real quick. Okay, via chat. Question is, if I have a personal residence and I then decide to rent it out, what basis do I use for the depreciation? The original purchase price or the value when I started renting it?
Good question.
Yeah.
It's going to be the original purchase price. Pretty
Okay.
simple.
All right, no confusion at all. Thank you so much, John. And another question. This is again from Facebook. This is third question and last question. If I have some rental properties in Airbnb where I provide other services like breakfast and cleaning, do I still need to consider it a rental or is it an active business?
Yeah, that area has kind of popped up in the last few years. And it depends. It depends on how much of the services you use and how long the rental period is. Um, so if you have mostly very short-term use of the property, and you mentioned providing breakfast and cleaning services. So if it leans more towards a hotel type situation, I know it's not a hotel, but if it leans more towards like a hotel situation where you're renting a room for a couple of days at a time and providing some services like breakfast and cleaning and maybe new linens, you may be the situation where it is reported on Schedule C versus Schedule E, and it is a quote unquote business as opposed to rental real estate.
Hmm. Okay. All right. Thank you so
And
much.
I would add, if you get a little unclear on that, one good source, IRS website, reporting rental property and Schedule C. There's some information there if you want to dig into that a little bit more on your own. Or like I said, feel free to call me.
Okay. All right. Well, thank you so much for that answer, John. I guess the bottom question, if you are new to the business, is that do they need to get a tax expert to help them out when it comes to filing tax return, especially if they're new to the business?
Sometimes in the first year that can be very helpful. There's a lot of software out there that does go through all the questions. When they do the interview section of the software, they're going to ask you a bunch of questions. You may be wondering why, just like somebody asked why is it asking me if I'm a real estate professional? Those questions are being asked so that the software can put your rental income in the right bucket and treat everything right. So having a professional do it the first time can be very useful. There's a lot of, the fact that you're coming here today trying to learn something means you're trying to do it yourself, which is great. We like that. If you're trying to do it yourself, do the homework like you're doing right now. Take a look into those things as far as depreciation and how much basis is, what different types of basis can be there. The IRS website can be a great place to start. There's kind of gets very technical sometimes, but there's a lot of information there, especially when it comes to like capital improvements versus repairs and maintenance. A lot of good stuff on that website.
All right. Well, thank you so much for that answer, John. That was actually our last question for today's session. Any tips that you can provide them for today? So basically, we have been catching your tip, which is I always also catch that always make sure to uh, open a separate bank account for your income. That way, it would be easier, which is really good and a good suggestion. Is there any other things or tip that you can provide them aside from that?
That would be one of my big ones to help make your tax time a little bit easier. If you want to learn a little bit more, if you're doing your own tax return, take the time when you get your return done to go read through the forms and kind of try to figure out what's there, where the money flows. I know it's a little bit wonky, but you can learn a lot if you spend that little bit of time up front, especially in the first year or two. After that, it'll come more naturally to you, but it'll probably help you understand of where things are going.
Okay. Well, thank you so much for that answer. So basically, the bottom line for this, if you are new to the business, it is really advantage if you get a tax expert to help you out, right?
It can help you out. Yep,
Yeah.
absolutely.
Okay. All right. Anything else that you want to add before I end this session?
That's it. Thank you everybody for attending.
Okay. Well, I want also to thank you, John, for taking your time to share your knowledge and giving us our real life examples. Truly appreciate your time and have a wonderful day today.
Thank you, man.
Welcome. All right. Okay. I also want to thank everyone for joining our session for today. And also, thank you so much also for attending and for your interest of joining our session. We truly appreciate your time. And with that, I also want to inform you that we will be having a lot of session about this. And if you want a more question, if you want to ask more question, you can contact our expert for today, John Shantz. With the phone number and email, you can contact him. And also, we want to let you know that our commitment is to make sure that we help you reduce your taxes and increase your wealth. We do this with a tried tax method of DIY, do it yourself, DIT, do it together, and DIA, do it all. Three methods, one solution. Reduce your stress from no IRS or state tax debt and a happier, healthier life. If you are not yet a member, please join for less than $20 per month. We need your support to continue to offer more of these sessions. Since it is now tax season, we have many sessions to help you do a better job of doing your taxes yourself. And of course, if you want help, we have a team of experts who can do your tax return for you. Please check our website also at taxresolutionhelpcenter.com and please join as a member today for $19.95 per month. Again, thank you all for attending and have a wonderful day.